Global trade depends on a system that most people never think about: marine insurance. While ships, ports, and naval forces are visible symbols of trade power, the real control often lies in financial systems, especially insurance. At the center of this system is Lloyd's of London, and the network of maritime insurers, operating through the international group of P&I clubs, which together insure the vast majority of the world's ocean-going vessels. In times of geopolitical tension, particularly involving Iran, this system becomes a powerful economic lever that can influence trade flows, oil prices, and even the trajectory of conflict. The backbone of global shipping: marine insurance. Marine insurance, particularly protection and indemnity (P&I) coverage, is essential for ships to operate internationally. It covers cargo damage, environmental liabilities, e.g., oil spills, crew safety and compensation, war-related risks. Without valid insurance, ships are denied entry into ports, canals, and international waters. This makes insurers not just financial intermediaries, but gatekeepers of global trade. London's dominance in maritime risk. London has historically been the global hub for marine insurance. Institutions like International Group of P&I clubs provide coverage to nearly 90% of the world's shipping tonnage. This concentration creates a unique dynamic. Risk pricing is centralized. Policy decisions have global impact. Withdrawal of coverage can halt trade instantly. In effect, London's insurance market acts as a silent regulator of maritime activity, war, and the economics of risk. In stable conditions, marine insurance premiums are relatively low and predictable. However, during geopolitical conflicts, especially in critical regions like the Strait of Hormuz, the economics change dramatically. What happens during conflict? War risk premiums surge from negligible levels to several percentage points of a ship's value. A single voyage can cost millions of dollars in insurance. Profit margins for shipping companies collapse. In extreme cases, the cost of insurance exceeds the value of the cargo being transported. When this happens, trade doesn't just slow, it stops. Insurance withdrawal is an economic weapon. One of the most powerful tools insurers possess is the ability to withdraw coverage. When insurers classify a region as high risk or a war zone, policies are suspended or canceled. Ships refuse to enter affected areas. Ports reject uninsured vessels. This creates a situation where trade routes are effectively blocked, not by military force, but by financial constraints. This mechanism has been observed during periods of heightened tension involving Iran, where threats to shipping lanes led to sharp increases in insurance costs and temporary disruptions in oil transport. Beyond military power, financial control of trade. Traditional views of war focus on military strength. However, marine insurance reveals a different reality. Trade can be controlled without naval blockades. Economic pressure can replace direct confrontation. Financial systems can dictate global movement. This represents a shift toward asymmetric economic warfare, where influence is exerted through markets rather than force. Marine insurance is more than a financial service. It is a strategic control point in the global economy. Institutions in London, particularly Lloyd's and the International Group of P&I clubs, hold significant influence over international shipping. In regions of geopolitical tension, especially involving Iran and critical choke points like the Strait of Hormuz, insurance becomes a decisive factor. By shaping risk perception and controlling coverage, insurers can effectively regulate global trade flows. As the world becomes more interconnected, understanding these hidden levers of power is essential. The future of conflict may not be determined solely by weapons and armies, but by who controls risk and who is willing to insure it.